Chapter 4, Portfolio Strategy. Section 1, Diversification. Diversification means spreading your money across different investments, so one weak area does not have too much control over your overall results. Because investments do not all rise and fall at the same time, combining different types of holdings can reduce the damage from one bad outcome and make the portfolio's path feel smoother over time. Diversification is most effective at reducing unsystematic risk, which is the risk tied to a specific company, industry, or sector rather than the whole market. If one automaker is hurt by a product recall, or oil prices hit energy companies, a concentrated portfolio can drop sharply, but a mix of different holdings helps keep any one problem from dominating your results. Diversification helps reduce company-specific risk, but it cannot remove systematic risk, which affects much of the market at the same time. Events like recessions, interest rate or inflation shocks, and geopolitical crises can push many different assets down together. So, a diversified portfolio can still lose value in broad market downturns, even though it is usually better protected than holding just one or two investments. Diversification is not just about owning more investments. What really matters is correlation, or how closely those holdings move together. If they rise and fall in sync, diversification is limited. But if they move differently, or sometimes in opposite directions, one can help offset the other's ups and downs. Lower correlation can make a portfolio's overall path smoother, even when the individual investments still fluctuate. Owning more investments does not automatically mean you are diversified, because a portfolio can still be concentrated if those holdings react to the same risks. For example, holding many tech stocks may look varied, but they can all fall together. True diversification spreads exposure across asset classes, regions, sectors, company sizes, and styles such as growth and value. Diversification can remove much of the risk that comes from individual companies, but the biggest benefit happens early and then starts to level off. Roughly 20 to 30 carefully chosen stocks across different sectors can reduce a lot of that unsystematic risk, while adding more holdings that look very similar gives only small extra benefit. That is why many investors use broad, low-cost funds to diversify efficiently, while remembering that diversification lowers risk, not all risk. A simple way to diversify is to first list everything you already own, then check for concentration in one company, sector, or asset type. After that, think about correlation too, because holdings that often move together may not give you much diversification even if they look different. The next step is to add assets that behave differently, so the overall mix is more balanced. Position limits, such as capping a single stock at 10%, and regular reviews can help keep concentration from building up again over time. With the same $10,000, putting it all into one technology company means your result depends heavily on that company's earnings, management decisions, competition, and the industry's ups and downs. Spreading the money across a U.S. stock index fund, an international stock index fund, and a government bond fund means risk is shared across many investments and asset types. A diversified mix can still lose value when markets fall, but it often has a smoother ride than owning just one stock. A common diversification mistake is thinking you're spread out because you own a lot of funds or stocks, when many of them may still be tied to the same sector or move together. Other traps include chasing whatever has recently done well and overlooking international exposure, which can leave your portfolio more concentrated than it seems. Diversification helps reduce concentration risk and can smooth returns over time, but it cannot protect you from broad market declines. Try a quick diversification check with 3 investments you own or are considering. Note each one's asset, class, sector, and region, then ask whether they're likely to move together or react differently when markets change. If they look too similar, make one simple adjustment for better balance, such as adding an international fund to a domestic-only mix, adding bonds to an all-stock portfolio, or including a REIT for broader exposure.